Hello again and welcome. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Today is Tuesday, March 22nd of 2022. Markets are moving and we're going to tell you why. Thanks for watching. So we had no shortage of a lot of dynamic movement within the fixed income markets, the bond market specifically, and that usually drives the equity markets, right? So because it's a cause and effect for valuation. So we spent a lot of time on the fixed income market, specifically with rates, the treasury market, the 2-year and the 10-year. And in the investment management world, we spent a lot of time on what's called the 2-10 spread. Historically speaking, why that matters is simply because it's an indication of a healthy economy, a strong economy, or economy that potentially is signaling in the future potential trouble ahead. And right now, that's what the 2-10 spread is potentially saying to us. So let's get right to the board and explain what that is very specifically and then go into the actual rationale behind it. Obviously, last week we know that the Federal Reserve Chairman Jerome Powell raised interest rates and finally got liftoff of 25 basis points. And that was the most anticipated time that we've seen. And since early January, in fact, back to November, we've been anticipating a positioning for our clients, and then we take advantage of when the market gives us opportunities, i.e. the volatility. Now, that being said, markets have kind of had a relief rally, especially last week, 6% on all indices, best since November of 2020. But also, we also had today, or actually yesterday, Jerome Powell, Fed chairman, came out and said, wait a minute, not only did he acknowledge that interest rates, the Federal Reserve is behind the curve in terms of raising interest rates, because if you look at interest rates, they're there. Yields are higher. Despite what the Federal Reserve says they want to do, the bond market has already moved in anticipation and pricing in what the Federal Reserve potentially could be doing for the greater portion of the remainder of this year. But not so fast, because the bond market is now signaling trouble ahead, simply because geopolitical events or economics are going to play a big factor, i.e. inflation is going to cut into the consumer. This is what I said on Yahoo Finance yesterday afternoon. So watch that clip if you want right afterwards, and that sort of gets into a greater context of what I was discussing here. But right now, let's go to the 2-10 spread on our board. We love to do that and love to educate, so thanks for watching. But 1 year ago today, we have this on our fact set, our Bloomberg machines, and we follow along. And this is squarely on our dashboards, all of us here at Blanke Schein Wealth Management in the investment committee world. And why that's important is because a year ago, we were looking at a 10-year treasury at 172. If you recall this summer, I was talking about the 170 level being very important. And the 2-year treasury was 15 basis points. Keep in mind, we had emergency accommodations, lower interest rates by the Federal Reserve, and that is rightfully so because of the pandemic last year. As we go 1 month ago for the 2-year and 10s, we have a 195 in the 10-year, 148 on the 2-year. And now what we do is we just take the 10-year minus the 2-year is the basis point split. So in the case of 1 month ago, we have 45 basis points. A week ago, we have 11 basis points because the 10-year was at 214. And the 2-year is at 203. That's okay. Interest rates are rising, and rising interest rates are not a bad thing for the most part because it indicates a strength in the economy. Okay, so to see interest rates rise over time means that we're coming out of the pandemic, and storefronts are opening up, and people are going out of their homes again, and the economy is getting back to normal levels. And a 2% to 3% 10-year treasury is not that. It's not a bad thing, and that's where the Federal Reserve is trying to take us, to a 10-year treasury closer to 3%. Well, today, right now, we're at 238. Actually, we hit 240 earlier on. But as I filmed this, we're at 238. And minus the 217 where the 2 years are, that's a 21 basis point split right now, or spread, okay? So this is really important. If we have this become negative, okay? It's not negative yet, but if that means that if the 2-year yields get higher than the 10-year yields, historically speaking, that's an indication. What the bond market would indicate and signal is that there's a recession ahead. Now, it's not 100%. In fact, it doesn't happen all the time. In fact, there's 3 times since post-World War II history where we've had it's called an inverted yield curve, where the short-term interest rates are higher than the longer-term interest rates, so it comes down like this. So shorter term is indicating that there's basically trouble ahead, anywhere from 12 to 18 months ahead in terms of a potential recession. Now, markets still can go up in recessions, and recessions don't have to be severe and as deep as they have been sometimes, historically speaking. So there's always ways to position portfolios and always ways to take advantage of it. That's our job, and that's why we spend extra time and overtime actually navigating through all of this volatility and taking advantage of that for our clients. So we welcome the change any which way, but we also want to monitor the change. So as of right now, these are still positive numbers. It's a positive spread between the 2s and 10s, but this is what the bond market's going to have to pay attention to. The equity market is definitely paying attention to, and Jerome Powell is going to have to pay attention to because he wants to raise the short-term interest rates, but he might not be able to. Now, how do we monitor this? Well, the banks right now, the banks haven't participated as much as they should have to sort of indicate that this is a confirmation that the economy is truly healthy. The banks actually haven't participated, which means that they're signaling that this could be correct. There could be, simply because we have this yield compression right now, as we're getting closer to potential inversion, the banks are signaling something. So we're watching the banks on our side to make certain that this confirms what the market is telling us. Also, why is the market up if all of this sort of negative news is swirling around, and specifically in the bond market? Well, keep in mind the markets have been down for quite some time for the last 3 months, and also as a relief rally in the last 5 to 10 days, especially on the end of a quarter, and that's what we're ending at the end of March is the first quarter. There's portfolio rebalancing, and if you portfolio professional money manager, foundations, endowments, institutions, by just their mandate, their investment policy, they have to true up to get to like a 60-40, 60 or 70-30 split. And if bonds are down but stocks are down more, they have to essentially sell some bonds and then buy some stocks to rebalance, and that's just a programming trade that we're seeing. Now, getting past the first quarter, we believe that once we have first quarter reporting of corporate earnings, we believe we're going to have some pretty good outperformance by corporations, simply because they're going to, earlier on when they provided guidance, all the CEOs said it's going to be a dismal year. So they gave Wall Street the lowest expectations or the lowest earnings hurdle potentially for them to jump over. And I think that's just where we're going to be. We're going to see maybe the first quarter earnings reports better than expected, which then continues to drive markets. So we could be in this little reprieve right now of the selling. It's long overdue. There's tremendous valuations. That's why markets are up. We got quarterly rebalancing. Looking into the first quarter earnings reports coming up shortly in April, and then we'll go from there. But that's our update for today. Thank you for watching. Then click below in the link to watch the Yahoo Finance link. And that was earlier on Monday, and we'll give you more insight of what we're thinking. Thanks for watching, and we'll see you again next time.